Welcome to Retirement Planning Solutions. We'll help you retire happy. Don't forget to visit retirementplanningsolutions.co.uk to claim your free consultation with top UK pension expert Michael Garvey.
If you're starting to look at your retirement financial planning, then you're clearly someone who recognises the importance of planning for retirement. But you'd be forgiven for getting a little dazzled by the retirement options available to you. This section aims to demystify these options and give you a clearer idea of where you stand in relation to your pension planning. You might be wondering what flexibility you'll have. Within a corporate pension scheme, there may not be much. You have to take what you're given. That is a tax-free lump sum plus a taxable pension for the rest of your life. There may even be a spouse's pension if that's part of the package. Personal pensions give much more autonomy and control over not only when but how you take your retirement benefits. You'll have access to your tax-free cash entitlement, your lump sum, from the age of 55. This used to be 50, and don't expect it not to rise again in the future. The remaining fund can either stay invested or go to purchase you an income, either by way of an annuity, that is the more traditional method of retirement financial planning, or by income drawdown. This is where the fund remains invested and an income is taken from that. Watch out though, as the rate varies and is not fixed like an annuity. Beware annuities when interest rates are low. When rates are low, this in turn means that the rate you'll get on an annuity and hence your income will also be low. For this reason, income drawdown is the more popular method of retirement financial planning when interest rates are low. Annuities provide more security than the income drawdown solution due to the income being fixed. An enhanced annuity is available to you if your insurer thinks that you might have a lower than normal life expectancy. For example, if you're a smoker, have type 2 diabetes, high blood pressure, cholesterol, or are overweight. Enhanced annuities provide a better income in retirement than their vanilla counterparts. An impaired annuity may be a type of retirement financial planning available to you if you have a medical history. For example, if you're in remission from cancer or have had a stroke. Again, much higher income is possible with this type of annuity. A variable annuity is a hybrid. It's part income drawdown, part annuity. This suits some people who are not committed in either direction. Are you looking to ease yourself into retirement? Phased retirement is a method that lets you take more or less cash depending on your needs. For example, more at the beginning of your retirement and less towards the end. Phased retirement is quite often used as a tax planning vehicle, as part of the lump sum can be taken in stages over time. An alternatively secured pension is what income drawdown becomes when you pass the age of 75. Trivial commutation is the name given to pension pots under the value of £18,000. If you want to retire abroad, you might consider transferring your pension into a QROPS. This type of retirement financial planning is sometimes used for the wrong reasons, but you can gain very significant tax benefits by moving your pension offshore. Useful if you're moving overseas, but this depends on your circumstances. As ever, it's important to take advice. Most responsible employers will have a corporate pension scheme in place. How much they or the employee contributes will vary from employer to employer. The important thing is that if your employer is paying in, then so should you. This is an important part of your remuneration structure. It's entirely possible that over a career you could have 3 or 4 different employer pensions that you would want to consolidate. Final salary pensions are a dying breed. They are normally employer or corporate pension schemes, especially NHS or civil servants pensions. What you get at the end is dependent on your length of service and your final salary when you retire. If you have one of these, remember that you still have options at retirement, even if your employer does little to make you aware of them. Enhanced tax-free cash is available to some people under old legacy arrangements. For example, executive personal pensions or retirement annuity contracts, which under former pension legislation give entitlement to more than 25% tax-free cash. Going for the early retirement option is something that, although they would like to, people often can't afford to do. Getting access to your pension early seems attractive, but what are the tax implications? If you take your pension early, can you continue to work? So we've seen that there are a number of options when it comes to retirement financial planning. One key thing to remember is that when your pension provider writes to you before you retire telling you that this is what your pension will be worth if you buy it from us, don't forget that you have the right to go to the whole of the market and shop around for the best rate. Another crucial point is that even pension income is taxable, so your tax position needs to be taken into account too when planning what to take and when. The only thing matching importance of planning for retirement is the importance of seeking advice from a qualified advisor before making any rash decisions over this very important part of your future. Visit retirementplanningsolutions.co.uk now to claim your free consultation with top retirement expert Michael Garvey.